We're opening this pre-market session with S&P 500 futures, virtually flat, nudging up just 0.02%.
Merely a flicker.
Not at all. Nasdaq futures are showing a tiny uptick, 0.1%, and the Dow is completely unchanged. It's early Wednesday, December 24th, 2025, and this is the definition of a pre-holiday hold.
It is, but that flatness on the screen, while technically true, it's incredibly misleading today.
How so?
Because we're looking at a market that's grappling with indecision right after closing at an all-time high. The overnight session gave us nothing. Zero fundamental shocks. The Eurozone manufacturing PMI data, it landed pretty much as expected.
It's a non-event.
Exactly, a non-event.
And crucially, that Fed governor's speech yesterday,
Right.
It just reinforced the wait-and-see approach. No new urgency, no panic.
Right. The central bank is basically saying they're happy to let this strong economic data run for now. And that's the conflict. That's what you, the active trader, need to focus on. We're consolidating after that huge Q3 GDP number, 4.3%.
Which is a genuine breakout signal.
Oh, a genuine breakout. And yet, the Fed is still cautious. The market is struggling to square that fundamental strength with the Fed wanting to stay neutral.
So the central question for this deep dive is this. Is this quiet pre-Christmas action just going to extend into year-end, grinding sideways on thin volume, or is something else happening?
Or are investors just repositioning, consolidating these massive gains, getting ready for the next leg up post-holiday? Because I'll tell you, beneath that flat futures print, capital is concentrating.
It has to be.
Oh, it absolutely is. When the indices go quiet like this, the money flow gets really, really focused on specific catalysts. We're seeing classic pre-market gappers driven by news.
And those are the stocks sucking in all the pre-market volume right now.
That's it. They're the telltales of where the real conviction lies.
Okay, let's follow that conviction. On the upside, tech giant TGC, it's gapping up 1.5% pre-market.
And the catalyst is exactly what this market wants to see.
Positive analyst coverage right after yesterday's surprise AI strategic partnership announcement.
That move is a textbook gap-and-go setup. Assuming the volume can sustain past the open, of course, it's an immediate re-rating based on future growth potential.
And it proved that the AI dominance narrative is still the engine room here.
It is. The market is treating any AI announcement as fundamental, long-term news, not just some fleeting headline.
But the downside flow is just as telling. Biogen Pharma, BGP, is taking a real hit, down 2.1% pre-market.
And the driver there is pure competitive pressure. A rival company just posted strong late-stage trial results.
So it's the classic zero-sum game in pharma.
Absolutely. A competitor's win in a key area immediately shrinks the total addressable market for BGP. It's a direct hit to their valuation. It just confirms that specific fundamental news is trumping everything else today.
And then there's Global Retail Solutions, GRS. It's up, 0.5%? Pretty modest activity on light volume.
This is just pure early holiday sales optimism slowly building. It suggests some sector-specific bottom fishing is happening, even while the big indices are asleep.
These low-volume drifts can often signal where smart money is positioning for the new year.
This concentrated activity is our confirmation. The market's hesitant to break the top of the range before the holiday, sure, but high-conviction directional trades, they're being executed.
So that brings us to the structure. We need to define those critical lines in the sand for today.
Let's lay out the framework. Remember, we closed at a record high on Tuesday, and that was backed by that stellar 4.3 Q3 GDP print.
The institutional verdict is breakout. It's not a liquidity trap, but the market always demands confirmation.
Always. And that's why we're not treating this flat open as weakness. We're seeing it as consolidation after a powerful move. So for the S&P 500 futures, the line in the sand for the bulls is that key October high at 69.22.
That's the resistance that needs a sustained break.
A sustained conviction break.
Yes, and sustained is the key word here. We've seen failed tests of levels like this before. A clear acceptance, and more importantly, a hold above 69.22. That's the signal that puts 7,000 in play.
That's the objective. Now, on the downside, you've got to hold the prior high ground. We're watching that critical support zone between 6,875 and 6,877.
That was resistance just last week.
And now it must act as definitive support. If you lose 6,875, if price just hangs there without bouncing, that is your first major sign of trouble.
But let's keep the real danger level in view. The point where you flip your bias completely, that's a break below the structure at 6,765. We need to stay well clear of that to keep the bull case intact.
Right. Now, flipping over to the Nasdaq 100 futures, the NQ, the fact that tech and growth are leading, even just slightly, It's a clear signal.
Capital rotation into high beta names.
Exactly. And for those not deep in the jargon, high beta just means stocks that tend to move more than the market. More juice on the way up, but also more risk on the way down.
And because of that volatility, the Nasdaq pivots are arguably even more important today. We have to watch the central daily pivot at 255.15.4.
That is the absolute core of today's action. Staying above that number signals immediate internal strength. It confirms that appetite for high beta is still there.
And if volume shows up and we push?
The first hurdle is the R1 pivot at 256.522.6. That's the confirmation level for the bulls. You clear and hold that, and the path opens up towards R2, which would confirm strong bullish control for the whole session.
Conversely, if this pre-holiday quiet causes a slump, we lose that daily pivot pretty fast. The first key support is the S1 pivot, 254.41.5.
And a clean break of that 254.41.5 level would suggest sellers have taken control. You can see downside accelerate really quickly, especially given how fast liquidity could dry up in late December.
So confirmation is the entire trade today.
It is. We need to see institutional funds step in and confirm sustained breaks of 69.22 on the S&P and 256.52.6 on the Nasdaq. Until that happens, we're stuck in a very tight, high-risk, high-reward range.
That structure gives us the boundaries. Now let's talk capital flow. Where's the money actually going? The narrative is still all about tech leadership.
Absolutely. And it's not just a bounce. Technology is getting a re-rating based on future earnings. The macro drivers are crystal clear. Unwavering investor confidence in AI integration, plus those really strong Q4 pre-announcements we've seen from semis and enterprise software.
These are fundamental shifts, not just technical spikes.
Exactly. Yeah. And the implication is a continuation of that leadership. If this conviction holds through the morning, we should expect rotation out of defensive plays, your utilities and staples, to pick up speed. Capital will chase the momentum and risk on high-growth names.
Which brings us to the tickers driving that story. We have three names with high relative volume and news flow you need to be tracking. First up, the bellwether. NVIDIA.
And its relative volume is already running hot, about 3.5 times normal.
The driver is huge. Reports of a new AI accelerator chip launch exceeding performance expectations, and that's coupled with an analyst upgrade to strong buy.
That's a powerful 1-2 punch, especially in a low-volume environment like this. It just solidifies their market dominance. So the bull case here, it requires a break above immediate resistance at $12.20 and $50.
You clear that with this kind of volume, and the next target has to be that big psychological number, $1,300.
It does.
But let me play devil's advocate for a second. Pre-holiday environment, it's reliant on an analyst upgrade. How do we know this isn't just a classic pump before a year-end dump? Can you really trust this news when liquidity is so thin?
That is the essential risk management question today, isn't it?
Yeah.
If that volume fades, you could see technical exhaustion set in right around the $1,240 area.
Yeah.
If the broader market fails, that 2,515.4 pivot, or if traders just lose interest, a break below $1,220 signals failure.
And it could test support back at $1,195 very quickly.
Very quickly. The volume has to stay elevated to validate the entire move.
Good point. Now moving from tech growth to pharma growth, let's look at Eli Lilly, LLY. Their growth driver is just as fundamental.
It is. The driver is positive late-stage clinical trial results for its obesity drug. But the key is it's for a new, expanded patient demographic.
Which broadens their total addressable market, their TAM.
Significantly. It essentially de-risks future revenue streams for years. And that's what institutions pay for. Reduced risk, expanded opportunity.
So the bull case is targeting $820 right out of the gate. And given the hype around this whole weight loss category, a push to $850 is definitely in play.
But the line you have to watch is $805. A failure to clear that could see a quick retrace. Profit takers will jump in, push it back to $790 support. And a move below $780 would be a pretty significant technical failure.
Okay, finally, let's touch on an industrial, Caterpillar CAT. This one feels like a purely rumor-driven trade this morning.
It is. Unconfirmed reports of major global infrastructure spending packages being fast-tracked.
But those rumors matter.
They matter because the market knows how cyclically exposed CAT is to government spending. So the bull case is a push past $360 resistance, looking toward $375. The thesis is that global infrastructure provides a multi-year growth runway.
And if those slowdown fears creep back in, or the rumors get shot down,
you have to protect your capital. A failure to hold $350 support could trigger a quick pullback right to the next major defense line at $340.
That gives us a pretty good micro picture. Now let's zoom out. We need to make sure the macro wins are still at the back of these high beta names. Let's talk yields and the dollar index.
Okay, so the 10-year yield is sitting at 4.17%. Now, yields have been edging up over the last month, which is normally a headwind for growth stocks.
Right, because rising rates hammer those long-duration valuations.
Exactly. But we're seeing a little pullback today. And more importantly, the market is aggressively pricing in Fed rate cuts for 2026.
So it's the forward narrative that matters most right now.
That's what's giving tech breathing room. Traders are looking past the next 6 months, and they're anticipating a more accommodative environment. It's the expectation, not the immediate rate, that's setting the tone.
Now, what's really fascinating, and probably the strongest tailwind for tech today, is the dollar index, the DXY. It's trading at multi-month lows, hovering around 97.84.
And this is a clear, unambiguous tailwind for large cap tech. I mean, almost every one of these giants earns a huge chunk of its revenue overseas.
A weaker dollar means those international earnings translate into more dollars when they bring them home.
It boosts their reported revenue without them having to sell a single extra product. It's like a built-in currency discount on all their global sales.
So net-net, the DXY is offering a huge tailwind, and that easily outweighs the mild pressure from the 10-year. The macro setup is leaning strongly towards a continuation of this growth trade.
It confirms the tech leadership we're seeing is fundamentally backed.
Right.
But we always have to think 2 steps ahead. Consider the hypothetical pain trade. The 10-year isn't spiking today, but what if it did mid-session? You have to be ready to manage that.
If yields were to spike rapidly, the less informed money would face the classic growth stock trap, chasing high-flying tech right as rising rates are destroying the value of their future earnings.
And critically, you would be missing the rotation. You'd be totally underweight the cyclical value plays, your industrials, your financials, which actually benefit when yields rise and signal a strong economy.
It just highlights why you have to be agile.
You need to know when to sell your winner and pivot if the macro flips.
So to summarize this quiet pre-holiday session, the S&P and Nasdaq indices look flat, but that number is deceptive. High-conviction catalysts are driving concentrated action in specific names. The overall market framework is leaning bullish, confirmed by strong GDP and a weak DXY.
Which brings us to the crucial question you need to be asking yourself as the opening bell gets closer. It's all about liquidity. Is this pre-market quiet, just smart money consolidating gains before they confirm those key resistance breaks, 6922 on the S&P, 25652.6 on the Nasdaq? Or is this volume divergence setting up a fast, violent liquidity drain later today that will catch positional traders completely off guard?
That divergence between the fundamental strength and this thin volume indecision.
That's where the true risk and the real opportunity lies today.